Next we begin Session K. Session K begins on page 26 in the gap portion of your book. So it's page 26, past your green tab. We start at the top of the page and we look at understanding flip taxes on cooperatives. So if you're doing flashcards, the first thing you want to do, make sure you put on one side of your index card flip taxes, and on the reverse side put co-ops. Okay, so whenever you hear the term flip taxes, co-ops is what you should think of. So at the top of page 26, flip taxes began as an attempt to solve problems inherent in the New York City housing market during the early 1970s. As many rental buildings were offered for conversion to co-ops, two main issues surfaced. First, an entrenched group of tenants living in rent-controlled and rent-stabilized apartments could not afford high purchase prices. And then secondly, many buildings were in bad condition, for their owners had long deferred necessary maintenance because their income from the apartments was severely limited because of the rent regulation. So advocates came up with this concept of a flip tax to help solve everyone's problems. As we continue, advocates representing tenants in conversion negotiations needed to find a way to fund future repairs and improvements without hitting the shareholders with whopping assessments. Now don't forget, a co-op is a property that's owned by the corporation, and the individual unit holders get what we call a proprietary lease. Again, that's a proprietary lease. If you can just take a moment and turn to page 62 in the front portion of your book, and as you turn to page 62, at the bottom of page 62, we talk about the differences between co-ops and condominiums. So in case you weren't made aware of this earlier, the reason why we jump around in the book is because the state added curriculum and the book couldn't be rewritten to follow the format of the state. So what we literally do is we give you direction on what to look at in your book at the appropriate sessions so that everything is covered. And it's really been working out well for, almost 20 years now that we've been doing our modular program. So at the bottom of 62 in the front part of your book, you do want to know the difference between co-ops and condos. So when you hear the term proprietary lease, you should put that on one side of your index card. Then on the reverse side, you want to put co-ops. Okay? So condominiums, you never use the phrase proprietary lease with a condominium. Because with a condominium, you own your interior space, you get a separate deed, you have a separate tax number, and when we say a separate tax number, we're talking about a SBL number, section, block, and lot. SBL number, section, block, and lot number. So you get your own tax bill. With a co-op, you don't get your own tax bill. The building is taxed as a whole, and then depending on what percentage of the square footage you have, you pay that percentage. So if you own 10% of the square footage of that entire property, you'll pay approximately 10% of whatever that total tax bill is. Okay? So very important. And again, this is just a reminder to you. And then the second paragraph from the bottom of 62. Under a typical co-op arrangement, title to the land and building is held by a corporation. So on a state exam, if they talk about a corporation and their question has anything to do with condos or co-ops, make sure that you pick co-op. That'll be your answer most of the time. So tenants buy stock in the corporation and receive a proprietary lease. And that's what they get to their apartment. And in New York City, I'll tell you, it's really a big deal. Like these co-ops are selling for hundreds of thousands of dollars or more. So as you continue, stockholders exercise control of the administration of the building through an elected board of directors. So a co-op has a board of directors. Not to be confused with an HOA, homeowners association. When you say homeowners association, you're generally thinking about condos. But that's not enough because you can have a homeowner association even without condo ownership. You can have a homeowner association for a subdivision that's set up by a subdivider who decides that they want someone to take care of the exterior items of a property. So you might be in a neighborhood where everything's a condo, but they look like freestanding single-family homes. And that's okay, because you can't look at a property and say, oh, that's a condo or that's a co-op. You know, and we'll be talking more about that in this session as well as we continue. If you could turn to page 63, just turn the page one page. I want to look at that first paragraph. The owner of each condo holds a fee simple title. Okay, so in a condo, you get fee simple title, or what we call fee simple interest. You don't get that with a cooperative. So please make sure you write in your notes, no fee simple title with a co-op. The only fee simple title you get is with a condo in terms of condos or co-ops. And as you continue here, you get an indistinguishable stated percentage of the ownership of the common areas. And in the deed for a condo owner, it will state what percentage of the common areas is owned by the individual unit owner. Okay? So indistinguishable means you don't know what percentage of the hallways, you don't know what percentage of the parking lots, of the service walks. You can't determine what's yours, and that's really super important. The last sentence of that first paragraph, the condo owners hold the common elements as tenants in common, with no right to partition. Please know that for test purposes. So condo owners hold the common elements as tenants in common. That phrase, condo owners hold the common elements as tenants in common, and no right to partition. That means the ability to separate a portion of it and say this is mine and this is someone else's. You can't do that because it's an indistinguishable portion. In the next paragraph, the condo form of ownership may physically look like an apartment, which would be found in an apartment building or complex. They may be freestanding or detached like a ranch-style home. And when I was referring moments ago to the fact that you may have condo ownership where there's a whole bunch of single-family homes in a particular neighborhood, if that's set up as a condo, then a lot of times people refer to that as patio homes. So if there's a patio home subdivision that you probably have seen at some point or saw it and didn't even know that's what it was, if you see a sign in the front that says this is blah, blah, blah patio community, that means that they're probably condos. And that's super important because when you list a property that's part of condominium ownership, you need to ask questions like, is there a homeowner association, HOA, homeowners association? And you want to get the restrictions and the rules and restrictions of that subdivision to make sure that your buyers know everything involved when they purchase there. What do they get and what do they have their rights to and what's their monthly fee? You always need to come up with whatever the monthly fee is, and that'll go in your profile sheet of the MLS system. In addition, many times when you look at the tax bill of a condo, it won't have a lot size listed in there. You know, like if you have a lot size of 15 by 130, then it's probably a townhouse that you're listing as compared to a condo, co-op, or some other type of regular fee simple estate that we normally deal with. So when the lot size is really small, it's probably a townhouse. I would write that down somewhere so you're aware of that, unless you already knew that. And then if there's no lot size and the lot size is 0 by 0, which is really common, if it's 0 by 0, that means it's probably condo ownership. Of course, if it's a co-op, you won't even have a tax bill because why? You should already know the answer to this. You won't have a tax bill for a co-op because the tax bill goes to the corporation. The corporation will have the tax bill and then they give individual statements to the individual apartment holders who have proprietary leases. Again, don't forget, proprietary leases go with co-ops. On the third line of the second paragraph, please note, a townhouse is not a legal form of ownership. It's a style or design. So common elements include items such as the land, the walls, the hallways, the stairways, and the roofs. Tennis courts, parking areas, lawns, swimming pools, clubhouses, and golf courses may also be part of the common elements. Third paragraph, page 63. Condo ownership is quite popular in many places for professional or medical office buildings in commercial areas. The term condominium could even apply to a group of single detached homes whose ownership was initially organized in this fashion. In some areas throughout the state, owners of single-family detached homes, homes that do not share a common wall, with a different neighboring homeowner, have even considered converting their non-condo ownership into condominium ownership to capitalize on the more lucrative tax and assessment advantages that condo owners have. Generally, on a per square foot basis, condo owners pay less than the same owner would pay in a non-condo type of ownership. The percentage of property tax paid could be up to 35% less, or more in some cases, than a non-condo owner might pay. You know, there's some properties around the corner from the school that are literally over $500,000, but they're established as condos, and they pay literally what you'd pay on a $100,000 or $150,000 house. Last sentence of that third paragraph. There's currently a push to change this loophole and limit the reduced taxation of condos and buildings that have a few stories. Zoning and other municipal restrictions may also apply. And when you associate with the office that you're going to be licensed and being sponsored by, they'll let you know about all of these. And if they don't let you know about, where the condos are in the areas that you'll be marketing property, you have to ask as well. Go out of your way. There's a lot of mediocrity out there, so, every office does training in a different way. Make sure to ask your supervising broker where the condos are in the communities that you're marketing in so that you have a general idea. You don't want to, I would rather in advance of going to a property that you're listing that it's part of a condo community than for you not to, know this in advance. And this goes back to the fact that you really need to ask for a deed every time you list a property. Because when you're listing a property, if you get a deed and the owners can't give you a deed, well, they might be part of a co-op. And that's the reason why. And we don't have a lot of co-ops in Western New York, but there are some. So if the property is actually a condo or a townhouse, you'll be able to figure this out by looking at the deed. That's why you should always do research in advance of listing the house, not just research on the comparable sales, but of course research to make sure that you understand everything about the legal structure of the property that you're listing. And that's why the first part of the book where we talk about legal issues is super important, and we get into a lot more earlier in the program. So this is just kind of fine-tuning the things you should know already if you started with the earlier sessions, after A or B. And if you didn't start with the earlier sessions, that's okay, because as it loops around again, it'll be covered. So by the time you've covered everything from A through N, you'll have everything that you need to know. It's kind of like putting a puzzle together, okay? And just to reiterate, now you know that if you get a tax bill, it's a townhouse, condo, or regular fee simple estate property. It's not like you're definitely not going to get a tax bill if you're listing a co-op. It's not possible. All right. So that's something you narrow down by doing your research in advance. Something else I can tell you too that's pretty indicative of a condo is that the SBL number, the section, block, and lot number. That's a number that sounds like 123.34-2-1. Okay. So why don't you write that down? SBL number. 123.34-3-1. So the first set of numbers with the 123 point that I mentioned to you a moment ago, that's the section number. Section. The second number that's identified after the hyphen is the block. So we have section, block, and then the third number is the lot number. So if you're dealing with a condo, you'll have everything I just mentioned to you, but at the end, it'll be there'll be another period or a decimal place. It'll be something like at that last decimal, it'll have 0.000010, and that might be unit 10. So the last part of a lot number for a condo is usually the unit number of the property that you're actually talking about, the what we call the subject property, the one that you're doing an analysis of. And you're not tested on that as far as the state exam or the school exam is concerned. But again, we don't want to just prepare you for every single thing that's going to show on an exam. Of course, we want to do that, but we also want to tie in everything that you're learning into the real world and what you should be doing and why you should be doing it. And again, when you get out there, people are going to say, oh, you don't have to do this, you don't have to do that. And there really is a reason why everything is done the way it is. Your chance of getting sued and running into problems and your chance of deals folding on you is a lot smaller when you dot your I's and cross your T's. And that's a problem with a lot of agents out there. They're just in a rush to hurry up, get things done, and the lawyers will figure it out. And homeowners are not going to refer you their friends and family for business if everything is screwed up along the way as you're going through the process. So there is a reason why everything is taught the way it is. So always be careful of people out there that's I don't care how many years they've been practicing in the business. They're just lucky that things haven't gone wrong if this hasn't happened yet. There's people that are in the business 15 years, and then some of these things come up after all those years. So, really, please follow what we teach and practice and question your broker. If something weird happens and doesn't make sense the way we're teaching it, once you're in the real world doing it, you should ask your broker. And I would challenge you to say, well, this is what the book says. Why is this not the case? And then you let us know. You let us know if your broker's telling you that something in that we're teaching is not applicable, especially the way we're describing right now. I've been teaching this for too long. I've appraised it. I've sold it. I've listed it. I've owned it, had it marketed, been involved with the home inspection end of it. I've been too active in real estate for too many years to say that what we're teaching really doesn't apply. And it drives me crazy when teachers tell you, oh, don't worry about this after you finish the exam. You just need to know it for exam purposes. It might take you 10 or 15 years to be active in the business before some of these other things hit you. But that doesn't mean that it's not important. Some people never take a licensing exam again. They get their salesperson license. They just take continuing ed every 2 years. And, they might not even be exposed to some of these things again. So that's why your book is so invaluable for many, many years to come. Fourth paragraph, page 63. The owner of a condo unit receives a separate tax bill and may mortgage the individual living unit. That's important. And actually, some banks won't finance some condos. Like if you have a freestanding typical home, like the ones that have a lot size of 90 by 140, and it's not a patio home community, and it's not in an apartment building. It's just a freestanding house like all the ones you drive by to get to school. Those are the easiest things to finance, assuming that there's no repairs required in order to close on the transaction. So if it's in move-in condition and there's no major repairs, the maximum number of banks that are out there that give mortgages, that's the easiest thing. When it comes to condominiums, certain banks only lend in certain communities based on them meeting certain standards. So if you have a lot of condos in the different marketplaces you sell in, like if you're selling in Amherst, for example, there's a bunch of communities here that are condominium types of ownerships. Clarence is the same thing. Clarence has a whole bunch of places that are condominium setups. So if your favorite bank is M&T Bank in order to get financing from, you want to talk to your representative from M&T Bank or whatever bank you like to use and ask, is ABC condominium community on your approved list? Because if it isn't, then you don't want to recommend your buyers to go to that bank, because buyers look to you for that information. So this is something you can do in advance of marketing a property. Or once you list a property, then you start, if there's that many condo communities in your area where you're going to be listing and selling them, then you can get this information and keep in mind that it's going to be updated periodically too, because maybe certain criteria, like once 1/3 of the condos are sold, then they might land up on more bank lists. So if you don't understand what I mean by that, jot that down and we'll talk about that after this segment. So I mentioned that your typical freestanding homes that are not part of condos is the easiest. Then if you're going down the list of the next most difficult, then you would have condos. And then the one that's even more difficult are cooperatives. You can't get a traditional mortgage on a co-op. There's only certain lenders, especially downstate New York, like in New York City, and the agents that are there, they already know who to go to for financing. And some co-ops, they don't even accept financing. It's either you pay cash or you can't buy in that co-op community. Some of the video clips that we have as part of this segment of the program will help to further reinforce that information for you. In the middle of page 63, fifth paragraph down. So the condo property is administered by an association of unit owners. It might manage the property on its own or engage a professional property manager. These are questions you need to ask when you're listing or selling a property that's in a condo association, so that because you need to confirm information with the various associations as far as making sure you're doing things right. Like, you might not be able to put a for sale sign on the front lawn, but you have to put it in the window. Some might not even allow a window. You may have to put them at the entrance of the park or the neighborhood that you enter into to get to the property. And when you have a condo or even a townhouse that might have an HOA, you want to document what's included in that monthly homeowner association fee. For example, it says here, water could be included, cable, television, security, recreational facilities, or various maintenance items. Now, if you're in a subdivision and it's not condo ownership, but they tell you that there's a homeowners association fee, you might be paying an annual fee of $75. Again, it's annual compared to monthly. There's a big difference, because when you have monthly fees, it's probably a condo. When you have annual fees, and it's usually an insignificant amount, like $150, $200, $75, that's probably paying for something like maintenance of the tennis courts or the greens at the entrance of the subdivision, something like that, something insignificant, okay? But still, even though it's insignificant, you want to make sure that that information is put in your multiple listing profile sheet. And if you don't know what I mean, jot that down, and that's going to be a question that you're going to want to remember to ask. So if you've attended other sessions of the program, you might have heard me talk about a parking lot before. And a parking lot is a place that you put information that's not going to be used right now, but it'll either be used once you're licensed later on or for a different part of the program. So this would be your parking lot where you put information for a later point once you're graduated and you're out in the field working. You want to make sure anytime you list a property that's part of an association, you want to find out what does it cover, and if it's an annual fee, that has to be put in your profile sheet as well. And a profile sheet is the thing that you fill out and submit for the multiple listing, and it identifies the name of the homeowner association, what's included, the taxes on the property, all the particulars of the physical structure, etc., etc. In the middle of that paragraph on page 63, when an agent lists or sells a condo, he or she should obtain a number of items from their client, including the name and contact information for the management company, copy of the prospectus or offering plan, and a list of the rules and regulations as well as any amendments that apply to the complex. The buyer's real estate appraiser and bank will also need that information, so you can really speed up the process. When the appraiser calls to set up an appointment, he or she, if they know it's a condo, which they will when it's ordered, will usually ask you if you have that they can review when they show up at the property. So that's just good professional practice for you as the listing agent of the property to have this information available so that the selling agent can show it to the appraiser and of course so that their client can understand what they're getting themselves into. Fourth paragraph from the bottom of 63. Townhouse ownership is a hybrid form. Townhouse occupants own the land directly beneath their living unit, including the roof, basement, and fee simple estate. So they have a fee simple interest. So it's a big deal because with a condo, you don't own the basement beneath you. You may have a right to a storage area that's designated underneath your property, but in many cases, you don't own the land that you're sitting on. You own an indistinguishable portion of it if you own a condo. Condo, you pretty much only own the airspace within your four walls. Anything outside is indistinguishable. Even the lawn in front of your property is part of the common areas if it's outside with a condominium. And one thing that I mentioned before is that with a condo, you usually don't have a lot size. But there's a trend lately that there could be a lot size identified on a tax bill. It's relatively new. It's only been around maybe 10 years. So if you do have a lot size, but the SBL number is kind of weird, the section, block, and lot number, if that lot number has a bunch of zeros and things at the end of it, there's a really good chance that you're still dealing with a condo. Okay, and all the rules we said really do apply. They might in their legal description identify land that you have the right to, but it'll still be an indistinguishable portion. So it can get a little complicated. Just don't go crazy. Just don't overanalyze it. The easiest way to remember a townhouse, it's basically a duplex that's split in half. You own one side, somebody else owns the other side. You get separate deeds, and you have what we call a common wall. You have to have a common wall for a townhouse. It's not possible to not have a common wall. Sometimes a townhouse is a one-story, but it's still split in half, so there's one side and the other side. Sometimes garages are what's in the middle. It'll be a two-car garage, but really you own one side and they own another side with a firewall between. In the middle of that paragraph, single houses on extra small lots in what is known as cluster housing sometimes use this form of ownership. A townhouse owner may sometimes become a member of a homeowner association which owns and maintains the common areas. Homeowner associations are required, now this is in bold for a reason, HOAs are required for condos, but not for townhouses or townhomes. So they're optional for a townhouse, but they're not optional for a condo. Never, ever, ever seen a condo without a HOA or homeowner association. Third paragraph from the bottom of 63, for tax assessment purposes, a homeowners association is distinguished from a condo homeowners association in that the units in a homeowners association are assessed in the same manner as single-family homes, therefore the assessments are typically higher. Then you need to know what a timeshare is. Timeshares exist in New York. It's not just a Florida thing. As a matter of fact, if you go to Florida, it's a huge thing down there, and there's like a whole separate license that they have that you can get from the Division of Business and Regulation. That's what they call their Department of State. So timeshare is a type of ownership in fee that is associated with resort areas. So if you're doing flashcards, on one side of your flashcard you put resort area, and then on the other side you put timeshare. It's also known as a fractional type of ownership. So you could even put with resort areas the word fractional ownership. So sometimes condos are set up with this type of co-ownership. Buyers of timeshares receive a deed and the right to use the living space for a specific portion of the year based upon prescribed time intervals. The time frame can be anywhere from a couple of weeks to an entire month or more. Timeshares may also be referred to as interval ownership or vacation club ownership. Sponsors wishing to market timeshares in New York are fully required to disclose the terms, conditions, and facts of the transaction to all prospective purchasers. Moreover, the seller must also offer buyers an opportunity to cancel their purchase. Again, this is to cancel their purchase of a timeshare within 7 business days after they have signed a contract of sale. Now, this is bold because it has shown up on the state exam, but it doesn't show up a lot. Sometimes it's kind of a throwaway multiple choice option. But just if you want to cover all bases, I would want to know that. Okay, and that's all you've really got to know on page 63 as far as condos, co-ops, and townhouses are concerned. So let's go back to page 26 and the gap portion of the program. Page 26. This is the section that follows the green tab. So in that first paragraph, let's just look at the last sentence because that's where we sort of left off. Attorneys came up with the concept of the flip tax. So buyers pay a reasonable purchase price up front, and then when they sell their apartments, they are taxed in order to bolster the building's reserve fund. So really the purpose of the flip tax is to take care of the property's physical attributes that might not have been as well maintained. So you don't have to have a flip tax on a co-op, but if you're going to have a flip tax, that would be the only type of property we would associate that with. In the next paragraph, second paragraph, page 26, this all seemed simple enough, but problems soon surfaced as the legality of some flip taxes were challenged. Generally speaking, in the early years, the courts sustained flip taxes as long as a proprietary lease gave the board the power to enact them, or if the bylaws included a provision on flip taxes. However, flip taxes enacted by the board decision alone were soon overturned by the courts. Nothing to worry about there as far as testing. We're just trying to give you a holistic understanding of that. And then they talk about a court case. In the third paragraph, I would read that through on your own. Just make a little note to give it a cursory read through. And then it continues the fourth paragraph. Just give it a cursory read through. Read everything else on the page, but let's together look at the bottom of page 26. Flip tax types include, number 1, a per share amount. Number 2, a flat fee amount. Page 27 has a percentage of the sales price, percentage of net profit, and combining methods. So make yourself a note to just give these a cursory read through. I never hear that they ask about the minutia of the different types of flip taxes. In general, there's going to be a question that says something along the line. If they're going to ask a question, it'll be a question that says flip taxes are most closely associated with which kind of property. And then, bam, you got it. You know that flip taxes go with co-ops. Okay? So in the middle of page 27, in the box, the standard form of contract for sale of a cooperative apartment has a paragraph that discloses who the cooperative requires to pay the flip tax. In other words, who in the transaction has to pay it. Because attorneys carefully protect their client co-ops from running afoul of the important 80-20 provisions of Section 216 of the Internal Revenue Code, co-ops will look to the seller to pay the flip tax before allowing the apartment to change hands. So in general, the seller will pay it. And a lot of times, the big expenses in a transaction, like the commission, is the seller usually pays that, and we call it an economic adjustment at closing. Big expenses are usually paid by the seller, and this would be one of those big expenses. So if you're doing a seller's net estimate, it's really important that you know how to calculate these different things, which is something that your office will teach you. Like you should know in general, as a real estate professional, you should know that costs associated with getting a mortgage are typically the buyer's responsibility. So the buyer will have to pay for mortgage tax, the bank attorney. The seller wouldn't pay for the bank attorney. It can be negotiated, but it's very rarely done. So the buyer pays for the bank attorney. They pay for their own attorney. The buyer will typically pay for title insurance because the bank won't give the loan without that. And then the seller, they pay for the search updating, the survey updating. The seller pays for the commission most of the time. It comes out of their proceeds. I also want to let you know that another expense for the buyer are any inspections that have to be done of the property. So the buyer pays for the appraisal of the property. The buyer pays for the home inspection of the property. The buyer pays for re-inspections of the property if there were any repairs called for by the bank appraiser. Just wrapping up that box in the middle of page 27, 95%, again, 95% of flip taxes in New York are paid by the seller. I would know that for test purposes. However, the seller is not prevented from putting in a contract provision to make the buyer responsible for actually providing these additional dollars. Many co-ops would then have to add the amount of the flip tax to the price if the calculation were based on sale price. So traditionally, when we have to add extra things onto the actual purchase price of the property, sometimes the concern is, will it appraise? And if the comparables don't support the value, then we run into a new problem. So always be aware of this. I would put this in your parking lot notes, that whenever extra costs are being added onto the purchase price, will the property still appraise? In the middle of page 27, let's look at some key terms and concepts that you should know. Condop, C-O-N-D-O-P. Condop is a marketing term. Again, that's important. Marketing term. Underline that. Condop is a marketing term given to a cooperative that has rules, regulations, and bylaws that are similar to that of a condominium. So all of that line is worth knowing. I would put on one side of your flashcards, marketing term given to a co-op. That's all. I would just do that. And then on the other side, put Condop. Because the question has to have the trigger word, marketing term given to a co-op. And then all the rest of it. You want to make sure your flashcards have the bare minimum amount of writing. So the freedom to sublet, putting an approximate minimum down payment of 10% for closing, and relatively easy board or no board approval are key characteristics found at a condo that has been adopted by the co-op. Closing costs for a condop are similar to a cooperative, so much lower than that for a condo, and the purchaser buys shares in a corporation rather than in the real property. So all of that you've got to know. With a condop, the purchaser buys shares in a corporation rather than the real property. And it shows up on the state exam. That's just bottom line. That has been showing up. Next, we look at condo rules and co-op legal structure, and we get more into a condop. As a matter of fact, that box that you see, condop rules plus co-op legal structure equals a condop. You know that. Just put that one side of your flashcard, condo rules plus co-op legal structure, and the reverse side, condop. Next, we look at corporation, the bottom third of page 27. Corporation is an artificial entity created under the laws of the state that issued its charter. Artificial entity is your trigger word for corporation. You can't ask a question about a corporation without artificial entity being part of the question. So question answer depending how they flip it around. One side of your flashcards, artificial entity, other side, corporation. So real estate owned by a corporation is considered an ownership in severalty. So again, flashcard time. Real estate owned by corporation, you put on the reverse side, ownership in severalty. Earlier in the course, we cover that an ownership in severalty is ownership by one. That's a standard. That's like Real Estate 101. Ownership in severalty is ownership by one. So it exists in perpetuity, which means forever, indefinitely. A C Corp, now here we get into, this is the more difficult part of the program for some people, and this is like Business Law 101. A C Corp is taxed twice, once on the profits and once on the dividends that are distributed to individual shareholders. It has no limitation on the number of classes or how many classes of stock that it may issue or how many shareholders it may have. It even allows for foreign ownership. It can be publicly traded, and other businesses can be shareholders, but not individuals. So all of that are the key attributes to a corporation, a C corporation, because there's other types. So again, a C corporation is taxed twice. That's been around forever. And the double taxation or the dual taxation is once on the profits of the corporation and then once on the dividends that are distributed to individual shareholders. It has no limitation on the number of classes of stock it may issue or the number of shareholders, because there are limits on the other ones. Foreign ownership is allowed with a C Corp. These are all the key attributes. So put a note to the right of this paragraph and make sure you identify that this is a need-to-know item. An S corporation, as we wrap up that paragraph, an S corporation may only have one class of stock. It may only have domestic shareholders, so no foreigners, and you're taxed once at the individual level. There's limitations on income that it may earn through passive activities. 20% is currently the rate. Now again, things could change a lot depending on the tax laws. So the publication 529, you're not tested on this, but if you want to put this in your parking lot, publication 529 is what I call the Bible of the IRS for real estate agents. It's for lots of small business, any small business. You should ask for, every year you can call the IRS and say, please send me a publication 529, or if you're at an IRS center, or they have mobile vans that do things, ask for a 529. They're free. And that gives you in the beginning of that 529, they give you all the changes for the year, things that are new and different you should be aware of. And it explains every section of a 1040 form and actually all the popular forms that are used. One of the best things you can do as a real estate agent is to take an income tax course, a personal income tax course, because you will learn how to spend your money in the smartest way so you can maximize your deductions, and also what deductions are likely to get you audited even if you have receipts. I make a conscious effort to not take all the deductions that I'm entitled to. And we used to have Esther Goulias come in and teach parts of our class, and she's the lady that does tax. She has a tax show on the weekend on the radio, and she always yells at me. She goes, "Mike, why are you like not taking all the deductions that you can?" And I've never been audited. Hopefully, knock on wood, it stays that way. And literally, I always want to have something so that if I did make a mistake and I do get audited, I can then show the IRS, well, here's everything I didn't take, and that'll offset it. There's certain, like a home office deduction is one of those deductions that you have the right to take if you meet all the criteria, but literally you can be audited and it can suck up so much of your time that it's not worth the amount that you were deducting. We actually have past students. I can think of a home inspector student that literally was audited because he took business use, office use of his home. He had a home office in the basement. They literally he lived in Colden or Springville, somewhere down there. They literally sent an agent out to his home after 3 years of going back and forth and fines and late fees. And, he had in his opinion, he had a legitimate deduction using his home office for his business. He was a contractor before he got his home inspection license. And they literally came out with a tape measure. He said it was a woman IRS agent, and she literally calculated the square footage of the area, said that part of that could have been used for storage, dual purpose. See, one thing they don't want you to do is use your home office and then the kids can sit there and play their video games and hang out, and they don't want that. They want it to be strictly office use. So any portion that was able to be used for personal, for storage, that disqualifies things. And it was unbelievable, the money that was spent for the small tax savings as well as the time that was wasted. So be real careful. It's a business decision for you to make whether you want to take every deduction you're entitled to. But if you can't prove it, or if there's any gray area, I would just avoid it. I'd rather not take the deduction and all the hassle that's associated. So let's look at an LLC. An LLC is a limited liability company. It's considered a hybrid form of a corporation. It has no shareholders, but it has members. So instead of shareholders, it's members. And it combines the freedom to manage the company offered by a partnership with the limited liability for all owners, and provides income tax advantages offered by corporations. And you see a lot of attorneys and professional entities like architects and engineers. They put together limited liability companies. An LLC provides more corporate protection than that found in partnerships. The owners pay taxes on the earnings and profits it receives from the LLC. Then another term you need to know in this section is homestead. The land that is owned and utilized as the family home, of which some portion of its value is generally protected from unsecured debts and judgments. And homestead's a bigger deal in most other states than New York, but just know that that's what it has to do with. That portion of the family home, of which some portion of its value is protected from unsecured debts and judgments. The bottom of 27. Did you know? In 2005, the state of New York updated the homestead exemption for individuals who are filing bankruptcy. A provision to increase the homestead exemption from $10,000 per person to $50,000 per person was signed into law August 30th of that year, and it became effective immediately. The homestead exemption means that creditors cannot place a civil judgment against the exempt equity in a debtor's home. In a bankruptcy, the homestead exemption protects equity in the debtor's home from creditors. Exemptions allow individuals who are filing bankruptcy to keep a bare minimum of property that is essential to their daily lives. Until then, if a married couple were filing bankruptcy, only $20,000 of the equity they had in their home would be exempt. Now, $100,000 of that equity would be exempt. At the previous level, the majority of people filing bankruptcy were in danger of losing their homes because creditors could file judgments against any equity above the $10,000 per person provision. So the homestead exemption applies to houses, condos, mobile homes where the client resides, and each state sets their own criteria for exemption. It's very rare to see a question about anything in this did you know box. But again, it's kind of like when a lawyer goes to law school. They're supposed to have a general understanding of all those McKissick books that have all the different rules and regulations they have to follow. And it's kind of like what it is for real estate. You know, you learn it. We're telling you it probably won't show up on the state exam, so focus more on the other things we tell you you're going to see. But just keep in mind that if you're reading something, you're dealing with something like maybe a homeowner who's filing bankruptcy and being foreclosed upon. Maybe this will trigger in your mind to remember, wait a minute, I learned something in my licensing class about the homestead exemption and how does that apply? It would be a question that you would ask the attorney that's working with the property owner so that you know, does a homestead exemption apply? You know, the big thing for you when you're listing and selling property is, am I going to be able to get paid a commission? Because if you're not going to be paid a commission, you know, it's people are not usually too excited to be involved in the transaction. I mean, it's you got to earn a living, you know. Turn your page and we'll look at the top of page 28, just 3 more terms, and then we've got this page covered. So illiquidity, you need to know this definition. It's the difficulty of converting an asset into cash because of a potential lack of demand for whatever it is you're trying to sell. So in the case of real estate, it refers to the difficulty of the seller being able to sell it and get full value on a relatively short notice. So illiquidity is referring, let's put it like this. If you own stock, you can sell it and turn it into cash in a relatively short period of time. Real estate has a lot more illiquidity to it because you've got to find a buyer, and the buyer has to qualify for a mortgage, or the buyer has to come up with the cash, and then if they come up with the cash, they still want to have the title checked out, and it still has to be surveyed, and you know, in other words, they just don't hand you cash and it's just a done deal in a couple of days. You know, it takes a number of weeks. So real estate's one of those items that have a lot of illiquidity to it. The second term is another one that shows up in this section you need to be familiar with. Real estate unities. There are 4 characteristics required to create a joint tenancy. Okay, so there's 4 characteristics required to create a joint tenancy: unity of interest, possession, time, and title. For example, joint tenants must have an equal interest arising from unity, the same conveyance, the same undivided possession, and the same use over the same time. Not that we've been seeing this on a state exam quite a bit, but as a general concept, just to, like if you can keep it in the back of your mind, that there's 4 characteristics to create a joint tenancy. So unity of interest, possession, time, and title. An acronym that we sometimes talk about, just to help make things simple for you, is PITT, P-I-T-T. So you've got the possession is P, the interest or unity of interest is the I, and then time and title, so P-I-T-T. Then the third item on this page, and the last item we'll be looking at on page 28, is subsurface rights. The ownership rights in a parcel of land of any gas, oil, or mineral rights that may be contained therein beneath the surface of the property. So if you're listing property in the city of Buffalo, subsurface rights is not something that's going to come up. It's really not. I mean, of course, there's no black and white in real estate. It most likely will not. But if you're selling acreage or you're in a more of a rural area, always remember, put this in your parking lot, please. Always remember to ask, have any mineral rights been sold off or leased on your property? Leasing is important too. If you're in a rural area, you need to ask, have you sold off or have you leased any of your mineral rights? And if the homeowner, usually like if they, let's say they get free gas, they may get free gas as a result of doing it. Well, you don't get there's no free lunch. So if they're getting free gas, then a certain number of cubic feet are allocated to that homeowner per year, and then the rest above and beyond that goes to the gas company or whatever the minerals are that we're talking about. Usually it's gas. Usually it's natural gas. So in your parking lot, make sure that whenever you start listing and selling in rural areas or semi-rural areas, ask if any mineral rights have been sold off. And that'll be usually noted in the deed if you have the most current deed available. But you want to document that you actually asked that question, so if there's a problem later on, it doesn't come up and say, well, hey, you didn't do your due diligence. We're going to take a look at some video segments now to reinforce some of the terms that we just covered.
Understanding the difference between condos and co-ops is something every New York City home buyer must know. It's almost as important as knowing that you can save thousands on your New York City property purchase by requesting a buyer's agent commission rebate from Housing. So what's the difference between a condo and a co-op? 1. Co-op ownership is not a form of real property ownership. New York City home buyers who purchase a co-op apartment actually purchase shares of stock in a corporation that owns the co-op. Owners of condos are considered owners of real property just like any homeowner in the rest of the country. 2. There are more co-ops than condos in New York City. Over 75% of apartments in New York City are co-ops. 3. Condos are much more expensive than co-ops. New York City condos cost 10 to 40% more than co-ops. 4. Closing costs are much higher for condos than for co-ops. New York City condos have buyer closing costs, which are roughly 2% higher than for comparable co-ops. 5. Co-ops have the most rigorous buyer board application process. New York City co-ops have a rigorous board application and review process for potential buyers. Buyer rejections for co-ops are much more common than for condos. 6. Co-ops have higher monthly maintenance charges. Monthly maintenance charges for co-ops are often higher than monthly common charges levied by condos. 7. Co-ops have stricter sublet rules than condos. Co-ops often restrict an owner's ability to sublet or rent the unit. Which is better? Whether a co-op or a condo is better depends on your personal situation. What are the rules and fees associated with subletting a co-op? If you are considering buying a co-op, it's important that you are aware of the rules and fees imposed by co-ops for sublets. How do I find out a co-op's sublet policy? An experienced buyer's agent can help you navigate the complexities of each co-op building here in New York City, including the sublet policy. In addition to receiving free professional advice and representation, you can save money on your purchase by requesting a New York City broker commission rebate from your buyer's agent. Can I sublet a co-op in New York City? Sometimes. Although most co-ops in New York City encourage high levels of ownership occupancy, the specific sublet policies of co-op apartments in New York City vary widely by building. Most buildings do permit shareholders to sublet their units from time to time. Compared to condos, however, co-ops in New York City are not generally viewed as being investor-friendly assets. What types of co-op sublet policies exist in New York City? Co-op sublet policies vary by building. However, the most common sublet policy permits 1 to 2 years of subletting each 5-year period, once the owner has lived in the unit for at least 2 years. Some co-ops either fully prohibit subletting or permit an unlimited amount of subletting by shareholders. What are the fees for subletting a co-op apartment in New York City? To discourage subletting and to increase revenue, most co-ops charge shareholders a sublet fee. These fees can be anything from fixed fees, fees based on the number of shares owned, monthly fees as a percentage of maintenance, increasing fees over time, to sublet fees based on the size of the unit being rented. Are you buying a co-op apartment in New York City? If so, you may be aware that the typical New York City co-op board package will ask for several personal reference letters. The personal reference letters you submit with your co-op board application are designed to help the board obtain a qualitative sense for how you are as a person. They want to know how you would interact with and contribute to their co-op community. The body of a personal reference letter should touch on the following points. How did the reference meet you? How long have you known each other? And why did you become friends? What sorts of activities have you attended together? Examples may include theater, sports, charities, a previous workplace, professional associations, or travel. Your references should also specify your defining character traits, offering examples of why words such as responsible, trustworthy, honest, and ethical are fitting descriptions. Your references should also highlight your educational background, as well as academic and other achievements if they are privy to these aspects of your life. Does your reference have any experience living in a co-op or being on a board? If so, including this information will increase the credibility of the overall reference letter. To avoid delays in submitting your co-op board application, it's suggested that you request reference letters as soon as you have a fully executed contract. If you have any questions about how many letters are required or who you should ask to write them, you should ask your buyer's agent to clarify the application requirements with the co-op's managing agent. It's also a good idea to request more than the minimum number of reference letters. This will avoid the risk of delays or having to be reliant on a less than stellar reference letter from one individual. One final word of advice. Each reference letter must include the reference's full contact details, including his or her email, phone, and address. You should also ensure that the letters are correctly formatted and are free of any grammar or spelling mistakes. Making an offer on a co-op in New York City is more complicated than submitting an offer on a traditional condo. Here are the steps for making an offer on a co-op apartment in New York City. Step 1. Request a buyer-broker commission rebate. In New York City, you can save thousands on your co-op purchase simply by requesting a New York City buyer-agent commission rebate. Broker commission rebates in New York City make sense for buyers because of the city's unique commission structure. All commissions are paid by sellers, and the total seller commission bill is not reduced if a buyer is unrepresented. As a result, the services of a buyer's agent are free to buyers. Yet most traditional buyer agents will keep 100% of the commission they earn by representing you. What if your buyer's agent shared some of his commission with you in the form of a cash rebate at closing? Because of the savings on offer, it's important that you request a buyer-broker commission rebate before you make an offer on a co-op apartment in New York City. Prepare your co-op offer documentation. Before making an offer on a co-op, you will need to prepare at a minimum the following documentation: pre-approval or pre-qualification letter, completed RIBNY financial statement. It's also important that your buyer's agent investigate the building's financial requirements to ensure that you qualify for the building before making an offer on the co-op. Step 3. Make an offer on your New York City co-op. Once you've finalized your offer documentation and deal economics, such as offer price, percentage down, and any contingencies, your buyer's agent will email your offer and supporting documentation to the co-op
Today's topic
listing
is
agent.
questions to ask before buying your New York City apartment. Number 1, sublets. This is a very common and important question to ask. What is the sublet policy? How often can you sublet? And how frequently can you sublet? This is a really important question to ask because you don't know what's going to happen to you in 3 to 5 years. You might move out of New York City, or you might get married and you need a larger space. Number 2, maintenance, common charges, and assessments. This is also a very important question to ask. Sometimes when you see a hefty charge, you want to find out the financials of the building. This also gives you a glimpse of what type of choices the board is making. And are there assessments that you have to worry about? So when a building is financially strong, oftentimes tenants don't need to pay for the assessments, and that's the best situation that you can be in. For example, they're remodeling the carpet in the hallways, or the lobby, renovating the lobby. And if this is no assessment to the tenant, it means that the building's financials are very strong. Remodeling. What is the building's policy on remodeling? For example, you might not have a washer dryer, but you want to install one in the future. What is the board's building's requirement and process like? What's the approval process like? Number 4, the neighborhood. How's the neighborhood like? Is there a nightclub that's blasting loud music at 2 in the morning? Or is it close to a restaurant that's carrying fumes and smells to your apartment? I'm not a fan of that. It really gets to my hair and it smells. I'm very sensitive to that. Number 5, neighbors. What kind of people live in the building? Fair housing laws prevent brokers to answer this question, but you could always go and ask your doorman or sit in the lobby and observe for yourself, just to see who's coming and going in this building. Number 6, heat and AC. Is the heater and AC centrally controlled by the building? If it is, then when does it switch over? Is there any way to monitor this individually? Number 7, amenities. Are all the amenities included, or is it a separate gym fee? And number 8, how's the board like? Is the board liberal or is the board conservative? You could also ask for a copy of the house rules. That's perfectly normal. Number 9, bed bugs. Has the building had a problem with bed bugs in the past? What's the current situation of that? What is the status? Has it been handled? And number 10, pets. You might not have any pets now. You might want to get pets in the future. You want to find out what are the policy on pets, guests bring pets over. What's the restriction on number of pets and size and the breed. Number 11, schools. What public elementary schools are in the zone, and are they considered good? Again, fair housing laws prevent us from answering this question, but you could also investigate on websites like insideschools.org or greatschools.org for more
apartment
information.
in New York City? If so, you probably know that before you can close on your purchase, you must submit a co-op board application, undergo an interview, and be approved by the board. Even if you've requested a buyer agent commission rebate and are working with a buyer's agent, you still need to know the basics of how New York City co-op board purchase applications work. What information is included in a co-op board application? The first component of a co-op board application is the purchase application. This section asks for general information about yourself and the proposed transaction. You will also be expected to submit a personal financial statement, proof of assets, previous tax returns, professional and personal reference letters, a copy of the executed contract, a credit report release form, employment and landlord verification letters, and photo ID. If you are financing the purchase, you will also need to provide a copy of the loan application, commitment letter, and copies of the Aztec recognition agreements. What are some tips for assembling a co-op purchase application? The most important things to remember when assembling a co-op board application are attention to detail and thoroughness. It's suggested that you type the application. Ensure that the figures on the financial statement correspond exactly to those of the supporting documentation, and submit certified checks for any fees. What fees are associated with submitting a co-op board application? The type and amount of co-op purchase application fees will vary by building. Some typical fees may include an application processing fee, credit and criminal background check fees, as well as move-in deposit. When do I submit a co-op purchase application? In most cases, you should begin preparing your co-op purchase application after you have a fully countersigned
This week's Real Estate Legal Advice: the importance of confirming the actual square footage in a cooperative apartment. Too many real estate deals have fallen through because of mistakes regarding the actual size of the units being purchased. The problem stems from the fact that a majority of offering plans of cooperative corporations do not list the actual size of the unit, but only the number of corporate shares allocated to the apartment. As the paperwork moves along, even the most skillful real estate lawyer may overlook this point. In the ideal situation, The purchaser will learn the actual size during the lawyer's due diligence investigation. However, in those situations where the size was overlooked, the purchaser will not discover the unit's true square footage until after receiving the appraisal report from the lending institution, if applicable. By this time, the purchaser may have a very difficult time rescinding the contract of sale, if he or she chooses, since most contracts do not represent the size of the apartment and have a disclaimer that all representations not included are not binding. With attention to detail from the beginning, this unfortunate scenario can be avoided.
A flip tax, something every buyer and seller of a co-op property needs to know about. When you're a buyer, you may not think you have to worry about a flip tax, since it is something the seller pays. But the truth is, whether buyer or seller, it's something about which you should be aware. When you buy a co-op, you have all your costs in the beginning, your upfront costs. When you go to sell, you do have your closing costs. However, there's one more thing when you sell that you should be aware of, the flip tax. What that is a payment that you give to the co-op, to the management company for the benefit of the co-op for their reserve fund. And the reason for that is to keep that reserve fund healthy. So, how do we figure a flip tax? Well, it's really different with every building. In some buildings, it's a flat fee. In some, it's a percentage of your sales price. In some, it's a percentage of what you've gained from the price you bought it at to the price you sell at, your profit. So it's really important when you're a seller to know what your flip tax in your building is going to be, because you want to figure out your net profits. And when you're buying, you might have quite a while before you actually have to worry about it, but you do want to know what your costs are going to be in the end
house
when you're
rules
done.
and how to enforce them and what not to do in house rules. So I see a lot of buildings, particularly ones that we are just taking over, where the house rules may not have been updated since 1985 when the building initially went co-op. And I've seen this happen where, I'll give you an example. Let's say somebody walks in, it's a pet-friendly building, but pets aren't allowed to walk into the front door. So the board says, fine them $50. And then an illegal sublet moves in, fine the unit owner or the shareholder $2,000. So I look at the house rules, it doesn't really tell us exactly what the amounts are for which infractions are going to be broken. So what do? One thing that the board could do is rework those house rules. And the board usually, I'd say 99% of the time, has the authority to actually amend those house rules so long as they're not stepping on the toes of the corporate documents such as the proprietary lease or the bylaws. You can do that on your own, and what I would suggest is redraft those house rules, and in the house rules have different segments of infractions and also different amounts for those infractions. So if somebody is moving out illegally, maybe it's a $500 fine. If somebody's walking their dog illegally, maybe it's a $50 fine. And then you have graduated steps, and it's laid out. So the first infraction is this much, the second infraction is this much, and maybe it leads down to eviction of shares. It could get as serious as that depending on what the infraction is. If you're disturbing the quiet enjoyment of everybody and it's on record and you have noise levels recorded and you could lock that down, that's certainly something that plays into that as well. So once the board actually redrafts those house rules and approves them at a board meeting, my suggestion would be to either mail them out certified to every shareholder or unit owner, or you could hand deliver, have them sign that they acknowledge receipt, and then once they've read it, you ask for a acknowledgement that they will abide by the house rules, they understand them, they've read them, they know everything that's in those house rules, they know what it's going to cost them if they are in breach of those house rules. And what we do is we go a step further also for all incoming sales applications and sublet applications and refis even, and transfer applications. We have a copy of the house rules and we have an acknowledgement form, and we're not going to process those apps until the acknowledgement forms are signed. So we know any new shareholder, maybe any new unit owner or a sublet coming into the building, they're going to be aware of everything. So I hope that's helpful. I hope that actually shines a little bit on what you should do with the house rules, because if you don't have anything and it's a little arbitrary, if you go to court, the judge may say, well, this is an arbitrary amount. I see nowhere in your corporate documents that's going to lead me to believe that they should be charged $5,000 for this infraction, case dismissed. So this is really in the benefit of all the unit owners, all the shareholders, and also...
Today we are going to discuss the advantages and disadvantages to purchasing in a condo building. I happen to be a big proponent of purchasing in a condo. I like that structure a lot. So first, let's begin with the advantages. The subletting policies are a lot less strict than a traditional co-op. Number two, the board application process, while you still have to submit a lot of documentation and they still do look at certain things, is less strict than a traditional co-op, and oftentimes you do not have to go for a physical board interview. Number three, your closing costs are less and completely in line with a co-op building. You don't have to pay the mortgage tax, which is required in a lot of condo buildings. Number four, you get a little bit more space at slightly lower price, so you have a little bit more bang for your buck. Number five, oftentimes you can find a condo building that allows for 90% financing, where with co-ops it can be very difficult and you have to put down at least 20%, 25% on a frequent basis to purchase in a co-op building. The downside for a condo is that you don't own title to the apartment like you would with a condo. All in all, I happen to be a big proponent of condos depending on your financial situation, the reserves you may have after closing, and certain other criteria.
Protection refers to the entity's capacity to protect personal assets from business creditors, and the requirements that must be met to maintain that protection. Taxation refers to how the profits of the company will be taxed and how owners will be paid by the company. A limited liability company, or LLC, is the most popular entity among today's new entrepreneurs. LLCs provide liability protection, creating a wall between personal assets like a home and your business creditors. But what makes them so popular is that this protection does not require compliance with a long list of regulations. Provided the owner keeps their personal and business finances separate, personal assets are protected. For taxes, LLCs are a pass-through entity. This means that the profits of the company are distributed to the owners and then taxed on their personal tax returns. While an LLC's legal protection is great, they do not provide any tax advantages to the majority of entrepreneurs. LLC owners pay self-employment tax on all non-passive income. S corporations, or S corps, are a modified version of a regular C corporation. S corps provide liability protection as well. However, the entity requires compliance to a list of regulations. If a small business owner fails to meet these requirements, which unfortunately most do, their legal protection can be left in question. Like other entities, S corps must also maintain separation between personal and business finances to ensure full liability protection. S corps are a pass-through entity. Profits are taxed on the individual shareholder's tax return and not at the corporate level. S corp shareholders do not pay self-employment tax on their profits. Instead, they pay taxes on a fair and reasonable salary that they choose based on their company's net profit. This means that rather than paying self-employment tax on their entire net profit, they only pay FICA taxes on a portion of their net profit. Profits not paid as salaries are passed to the owners as distributions, which are not subject to self-employment or payroll taxes. So, which entity should you choose for your business, an LLC or an S corp? If your income is passive, meaning you are a silent partner or looking to protect some kind of investment income, then you should choose an LLC. You won't have to worry about corporate regulations, and there will be no self-employment tax on your income because it is all passive. What about the rest of you? Which one should you choose? With few exceptions, the answer is neither. Let me explain. LLCs are favored by attorneys for their ease and liability protection. S corps are favored by accountants for their taxation. But both sides seem to ignore each other. The truth is, small business owners need liability protection and tax savings and shouldn't have to sacrifice.
So a C corporation is any corporation that's taxed separately from its owners. It's legally viewed as an individual entity.
And C corp determination is not a feature of corporate law. Okay, C corporations is something invented by the IRS. Okay, so you don't go to your Secretary of State to say, I want to file a C Corp. Your corporation, and actually other entities, can elect to be treated as a C Corp.
Yes.
Or they will be, by default, treated as a C Corp, and you have to elect something else if you don't want that.
Okay. So let's talk about the good things first. Okay. If you need a lot of startup or expansion capital, it's easier to raise because you have stocks to sell.
Right, and that's important because you don't have to dip into your cash flow.
Right.
That, basically they're, stockholders, and so they're going to, they'll profit when the company has its big payday.
Yep. No shareholder limit, but once the corporation has 500 shareholders and 10 million in assets, it's required to register with the SEC. But
Right.
there's a but here.
Right. So there's no, so with a C Corp, there is no shareholder limit. That is the IRS. That's the IRS law, right? But your corporation may have a limit to how many shareholders is, in particular, if it's a closed corporation. So that's just something that you have to always remember, that you have two different laws you're dealing with: the tax code and then the corporate code of whatever state you have, or foreign country
Yep.
you have incorporated this in.
And we will get more into depth in the benefits of different states
That's
as,
right.
as
Yep.
the series continues. Now, if you intend to eventually take the company public, it must be a C Corp or it can be an LLC to be traded on a national exchange.
Right. It has to be a C Corp, but it doesn't have to be a corporation. No, does that make sense?
Yeah. Well,
It could actually be an LLC
yes.
that elects to be treated as a C Corp.
Yeah. And that's Form
8832, I'm going to think.
I think. We will verify
Yes,
that.
we'll verify.
Okay, so another good thing is limited liability. This applies to the directors, shareholders, officers, and employees. This is, again, something that varies by state that we'll talk about: Delaware, Nevada, Wyoming,
right.
as the series continues. But it's good. I mean, if the corporation sued, shareholders are only liable to the extent that they invested in the corporation.
And it's also true for S Corps,
Yep.
the other type that we'll talk about later. And also true for LLC, the limited liability
Yes.
applies. Also for limited liability partnerships, and limited liability limited partnerships
Yeah.
exist in some entities.
This way, your assets aren't
Right.
on the line.
So it's not anything unique to a C Corp, but it's something that is a huge benefit. And by the way, it is Form 8832.
Oh,
we
we're
were right.
good.
Yeah.
Any debts the corporation has are viewed as the corporation's responsibilities. And what I found is a lot of small companies opt to incorporate to protect themselves instead of getting expensive insurance. So it's sort of an option there.
Right. And that would be that, remember my awesome tax proposal? If we got rid of, if we made the taxes a little lower, and if we made it so that, hey, look, if you want to have limited liability, then the IRS is free to tax your income because your corporate entity is a fiction of the state. If it's a fiction of the state of the government, well, then they have the right to go inside your books. And I think it's a fair trade-off. If, on the other hand, you want the government out of your books, well, then you can't claim that limited liability. So what you would want to do is insure against possible lawsuits.
Got it. Now, a big thing with C corporations, S corporations are the taxes.
Oh, yeah.
And we'll start with the benefits and then maybe talk about some of the drawbacks. The cost of fringe benefits is deductible by the corporation, not considered taxable income to the employee. So the more fringe benefits you have, the better. So that's something to consider. To be eligible for a tax break, a large portion of the employees, usually about 70%, must be able to take advantage of the benefits. So for a lot of small businesses, the expense is too expensive to be an advantage. They can't afford to do that.
And I don't know if I'm going to jump ahead, but
Yep.
do we have this as one of the big advantages of a C Corp? Is you're allowed to give stock options,
Right.
Which is critical when you're a growing company. If you're a startup, first of all, your venture capitalist. If you're looking for an IPO, there's very few IPOs going on, but more if you're looking for be a target of an acquisition. If you're not offering stock options, you got a problem because they're going to look at, well, your employee retention probably isn't all that great. I would say one of the most important things of going with the C Corp is that you can now offer those benefits. With an S Corp, you can't
Yep.
because really everything's passing through to whoever the shareholders at. That doesn't work with a company with many employees.
Exactly. Now, when we talk about the drawbacks, there's a big drawback.
Oh,
It's
it's
the big-
huge. It's the biggest one there. It's the number one drawback is that you have the possibility for double taxation.
Yes.
And that the corporate tax rates for the U.S. tax rates for C corps are the highest in the world. And it's sort of the brackets, they just call them surcharges, but it's one of the most interesting ways that they have. Now, your first $50,000, right, is taxed at 15%. But things jump up significantly. We go to 25%, and then we go to 35%, and then we go to it keeps growing here. And I gotta hang on one second here.
So the more money you make, the
The
more
more
you're
money you
taxed.
make, right? So the first 0 to 50,000 is 15. 50 to 70, 50 to 75, 25, 75 to 100,000, 34, 100,000 to 335, 39. I mean, these are just incredible jumps.
Yeah.
And I'm sorry, but a corporation making all that, that's not a lot of money to say, hey, we gotta go after these rich corporate abuses.
Yeah.
Are you kidding me?
Yeah.
The guy, wait, they made $75,000, and so you're going to hit them with $34,000. Then it goes up again to when the 100,000 to 335,000 to 39%.
Not 39.6?
Yeah, right. It's not the 39.6, our favorite highest ordinary rate. But then it drops down when 335,000 to $10,000. Of course, your total tax liability is higher. And then it goes a little bit up for 10,000 to 15,000 to 35. And then for over 15,000 or 15,000 to 18 or 15 million to 18 million, 38. And then over 18 million, 334. And these do typically adjust for inflation, 35%. So you can see there's a few places there where it really stinks. And now that is the corporations have to pay taxes on that, right? So these are really high rates. Now there's no self-employment taxes in there too. The corporation is deducting the employment taxes from their profits, even though they're paying them. They are paying them, or they should be.
Yep.
So these are really, really high rates to begin with. So, this is the thing you have to decide. And plus, we're not done yet. Because if the IRS, this is what you're taxed on, whether or not you make a dividend, distribute it to anybody.
Yep.
Corporation sits on it. So what? You're paying it. We don't care. And you're allowed some working capital that they won't tax you on. But if they feel that you're holding on to too much money, they're going to hit you with an accumulated earnings surtax of an additional 3.8 or 3.9, something like that.
And that's at their discretion. There's no
Somewhat at their
percentage?
discretion. It's not a percentage. It's, you don't need this much, because it's going to vary from business to business. Businesses with high seasonality, you can probably get away with more working capital.
Yep.
Businesses are growing too. But something that's a business that's pretty much the same thing in and out. Hey, look, we know you need this much to meet your next, to keep your cash flow going. So that's really the thing you have to watch out for. Then now you have to. Then when you make a dividend payment to a stockholder, oh boy, now they're going to be taxed at the 15% or 20%, depending what bracket they're in. So you could see whoa. We're paying 60% tax rates, and this is just federal, because the states, depending on what state you're in, they're going to want something too.
Right.
So this is just crazy when you think about, oh my God, how much money does a corporation have to make to be profitable to overcome this crazy tax system? So one thing you could do is make a crazy profitable corporation, or it's just easier to find some tax strategies so that you avoid this. And there's a lot. We'll be talking about those in an upcoming series, because there's a lot of things you can do, and it is one of the most interesting sort of challenges. It's a chess game. There's a lot of moving pieces.
And the IRS does know about a couple of the tricks. Some corporations pay all their shareholder employees higher salaries, as opposed to distributing income as dividends.
Right.
But the IRS looks and goes, wait a second.
Yeah, and that's not even a great loophole, really, because essentially all you're doing is taking a tax treatment that's worse than if you were an S corporation. An S corporation, all that money will flow through. You could give it all to your shareholders, and the shareholders will pay the ordinary taxes, but they don't have to pay on the dividends. They don't have to pay self-employment taxes. So a little bit of savings on that.
Yep.
So even that isn't That's not like, okay, because they really could be paying a 39.6% effective rate on that bonus plus their state taxes. So, okay, so we went from 60 effective to 50. Right? Is that really worth it? Wow, what a great deal.
Yeah. And then, if you're thinking about starting a C Corp, I would say another drawback besides the double taxation, just confusing. There's a lot of legalities. It can be expensive, more expensive to start a C Corp than an LLC. It's something where you would want to consider maybe hiring help.
Yeah, and you have to say, okay, you're going to be a corporation. If you're going to own it yourself and not really have the shareholders, it's really going to be your alter ego. You have to understand, you have to go through the corporate formalities. I remember my dad we were working on some case, and the person had, I think, a medical practice, and it was a corporation. And my dad asked for the meeting minutes. And it was just, this is a corporation. It was all owned by the doctor. Mm-hmm. Why would I do that? Well, you have to keep your meeting minutes, but it's just me. Okay, but you still have to put down, like, yes. We had our shareholders meeting. We declared this. We did this, this, and this. So, and if you don't, then basically what could happen if you're sued, they could say, well, this isn't really a corporation because you're not treating it like a corporation. That's the whole issue. When you don't treat something like a corporation, that limited liability, you're going to lose. And the IRS can also say you're not doing it. So if you don't go through what's required, you're really not doing much of anything. That's why the LLC is much, much simpler. You don't really, no one's going to give you that hard of a time. Yep. Even though you do have your meetings, it is a lot easier. So that's something to think about. Are you really somebody who's going to, sit down, write down and say, oh yeah, we had our meeting of the minutes. We all were present.
Yeah, I was looking at one of the IRS documents about C Corps, and it was like 28 pages, and a lot of it was covering the very specific record keeping requirements, exactly what you have to keep, how long you have to keep it. You have a requirement to hold a formal board and shareholder meeting and keep accurate minutes of the meetings. A lot of tax forms to fill out, often requiring an accountant. These aren't things you're really doing on your own. And then C Corps, the government sort of pays more attention to them because there's so many specific tax laws. So be ready to be under a microscope, unless you do things correctly.
Well, you're also going to be under a microscope. So that's the incentive. I mean, I think no matter what, you're going to be under. So this is not the area where you want to just sort of slap something together. You can get away with a lot of things. I mean, the truth is you can get away with a lot of things.
Until you don't.
Until you don't. But when when you are filing Form 1120 as a C Corp, you are in the same, you're starting to become the same sort of big boy as a multinational corporation. And they're going to say, well, you're a corporation. You should know all of these and you should have your professional. So, the standard that you're going to be examined under is going to be higher. So just be aware of that.
Yep.
Okay, we're going to continue session K and look at page 77 in the gap part of the program, page 77, and it's the section that starts off with condos and co-ops. So let's look at some of the terms that we should know in the middle of the page. The shortest possible version of a condo definition is shown there. A building that includes condominium and co-op ownership in the same structure. Then we look at the term due diligence. This is the prudent review by a buyer, accountant, and lawyer with regard to the financial status of a co-op. A little further in that definition, this includes a review of the annual financial statement, common area charges when tax abatements expire, whether a flip tax applies, the amount of the reserve fund, if it's adequately funded based on the age and condition of the property. In other words, the due diligence is to make sure that the buyer isn't purchasing a property where there's going to be a huge increase in monthly association fees or additional fees as a result of inadequate funding of monthly fees. So read the balance of that definition on your own and make sure you own it. Then we see subscription agreements. Subscription agreements are the contracts to purchase shares of a stock in a co-op corporation, typically used by the sponsor when cooperatives are first being developed and sold. These agreements are included in the offering plan that are filed with the Attorney General of the State of New York. So with condominiums, we use the term letter of intent. So subscription agreements are the contracts that are used to purchase shares of stock in a co-op corporation. Please be familiar with the difference between letter of intent, which is the same definition but used for condos, and subscription agreements, which are used for co-ops. Then we see offering plan. This item includes a declaration and disclosure statement with the Attorney General's Office for the state of New York. So the offering plan includes the declaration and disclosure statement. The rest of that sentence, the scope of the project, the description of the corporate setup, and the preliminary prospectus are all part of the offering plan. So there's really two definitions you want to know here. What is an offering plan? An offering plan is a declaration and disclosure statement that's filed with the Attorney General's Office. And what's in an offering plan? Well, the scope of the project, the description of the corporate setup, and the preliminary prospectus. That's all part of what makes up an offering plan. You should also know, and this is like a state exam favorite question, that another name for a preliminary prospectus is a red herring. You just got to memorize it. So on one side of your flashcard, you put preliminary prospectus, and on the other side, you put red herring. Then we look at house rules at the bottom of 77. In co-ops, it is the rules of operation covering maintenance, garbage disposal, conflict resolution, noise, etc. I like this term because it's what it says. I love when a term identifies exactly what it is. There's like almost no memorizing needed. Except you do need to know that house rules are something that goes along with co-ops, not condos. So house rules in co-ops are the rules of operating covering the maintenance, garbage disposal, conflict resolution, your day-to-day operations of that property. They're generally more detailed than the items found in the proprietary lease. The house rules deal more with day-to-day items that will impact tenants. So again, it's something else you want to ask about when you're listing and selling co-ops. Page 77 concludes with an alteration agreement. The terms under which the co-op gives permission to a shareholder before, underline before making any changes or improvements to the unit the shareholder or stockholder occupies. So this is the alteration agreement is a separate agreement between the tenant shareholder and the co-op corporation. Again, just another term to memorize that could show up on that part of your exam. Then we look at board package on page 78. Board package are the financial documents that the purchaser submits to be approved by the cooperative board. So these documents include tax returns, bank statements, verification of employment. In other words, this is how you prove to the board that this person is worthy of being admitted and purchasing this co-op unit. Second paragraph, the managing agent of the co-op will review the package before it's passed on to the board for review and subsequent approval. The managing agent and the board usually charge a fee to review the board package, and the fee is submitted with the package. This way they get really people who are qualified. That's part of the qualification process. And if people are just throwing out random numbers and if they're not really submitting a good qualified bona fide offer, they're not going to want to just throw money away if they're lowballing, for example. So last sentence in that paragraph, there may be a special committee in place that reviews packages of the co-op, generally the case with large corporations, or all board members may read the package as part of the approval process. Then we look at a share loan, a loan used to purchase a co-op where the shares serve as collateral for the loan. Just highlight that, know it. The shares are pledged by a security agreement instead of a mortgage being recorded. Because remember, I said this is the most difficult property to finance. So only certain banks will provide this kind of financing. And again, there's so many, especially in New York City, that you have to pay cash. You can't even get a mortgage if you wanted. Instead of a mortgage being recorded, a UCC financing statement is filed in the county clerk's office. The lender then takes possession of the stock or membership certificate as evidence in the ownership of the shares in the co-op corporation. A lien search is performed by the lender, kind of like what they would do for a fee simple mortgage, but with a co-op, the search is against the unit, owner, and building. Then we see co-op recognition agreement next. An agreement between the co-op management and the lender that describes the actions by each party if a shareholder or member defaults on the loan. It generally includes a requirement that the co-op board will notify the lender if a member misses a monthly maintenance payment. So the co-op recognition agreement is between the co-op management and the lender. That you want to know. Just know that, underline. Co-op management and the lender. It describes the actions of each party if a shareholder defaults on the loan. So the bank doesn't want to be left out of the loop. You won't even get a co-op loan without doing a co-op recognition agreement. So it includes a requirement that the co-op board notify the lender if a member misses a monthly maintenance payment. And that, you're probably not shocked to hear that. You're probably like, okay, that makes sense, right? Then we see the term sponsor. The owner or developer, that should be or, the owner or developer of the condominium or co-op. So the people who develop the condo or co-op is known as a sponsor. Just got to know that. It's Real Estate 101. The sponsor will appoint the initial board of directors, and in the case of a co-op, board of managers. So board of managers is a phrase we use for the board of directors for a co-op. Board of directors is typically used for an official corporation, that we're not talking about a real estate corporation, which is a co-op. So they appoint the initial managing agent and they place a limitation on sponsor control of the board. So in New York, the Attorney General requires sponsors to promise within the offering plan to give up control of the board after they sell more than 50%. That I would know. So once more than 50% of the common interest, or after 5 years have passed, whichever comes first, the sponsor agrees to give up control of the board. Then we see a co-op policy statement, CPS 1 phase. This governs the rules on how a developer may test the market for a new development before filing an offering plan and before the construction is completed. This CPS 1 statement also identifies the rules on how the development may be advertised as approved by the State Attorney General's office. During this period, the developer cannot declare a firm price. Only price ranges can be discussed, even though prices may vary later on. So this CPS 1 lasts for 120 days from acceptance. Please know that. The CPS 1 period lasts for 120 days from acceptance of the CPS 1 statement by the Attorney General, and it can be extended for an additional 60 days. I'm sorry this is painful, but I'll be honest with you, when we talk to our New York City agents, they hate everything they've got to learn about septics and wells. They say, we don't have septics in New York City. You think there's septics in Manhattan? Of course. They hate what they have to learn about our stuff, and we hate what we have to learn about their stuff. But New York doesn't really care. You got to know it, because your license works in New York City just like their license works in Buffalo. At the bottom of 78, overview of cooperatives. So know that they come in all shapes and sizes, and not too many look alike. So we must be talking about condos and co-ops. It's not an architectural style. When you hear a condo or co-op, you just have to have a blank mind and don't think that it looks like a certain type of property. At the bottom of 78, generally the attorney representing the seller prepares the co-op contract of sale or binder supplied by the real estate agent. So binders are used in downstate New York. Contracts are used in upstate New York. That shows up on the state exam. Offers may also be oral, but they're highly discouraged. Once both parties agree on terms of the sale, purchaser assembles a board package. Okay, know that phrase. Once both parties agree on terms of the sale, the purchaser assembles the board package. After the package is accepted by the board, a face-to-face interview is usually conducted by the co-op board. Since boards usually meet once a month, the timing of the package preparation and submission is very important. And if you're dealing with co-ops, your office will make sure you know about all of that. Top of page 79. At the interview, there may be many questions from the board members, including who's going to live at the property? Is there going to be pets? Or they might also ask questions about financial items that are contained within the package. It's basically, they want to find out what the purchaser's motivations are for selecting the apartment that they did, that co-op apartment. The real estate agent's role is very important here in preparing the buyer for the various questions in advance. You know, you need to have a little pep talk with them, essentially. Now, again, if you're in Western New York, this is all a foreign language, but just be aware that if you ever relocate downstate, that this is part of what you do, and it's just normal everyday procedure, not a big deal. Second paragraph, page 79. Subletting of units is generally discouraged at most co-ops, and sometimes buildings with too high of a percentage of sublets may become more difficult to obtain favorable financing terms for when they refinance or sell. The large secondary mortgage market participants, and you should know for test purposes, Fannie Mae and Freddie Mac is an example of the large secondary mortgage market participants. Matter of fact, a lot of the rules that we get for financing come from what their requirements are to have loans bought back by them. So they require high primary tenant occupancy levels to get the best financing, because people don't stop making payments on the home that they're living in. But if you have a rental property and you live in your own separate primary residence, if you run into financial problems, you're going to stop making payments on your rental property before the roof over your head. And the bank knows this. So that's why where there's a high percentage of rentals in a cooperative building, you're going to have a problem getting favorable financing terms. So that's why all these different rules are in place. Third paragraph, page 79. If a sponsor owns the shares allocated to the apartment, he or she may be permitted under the bylaws or rules to sublet or even rent a unit, even though an owner cannot. When a purchaser buys from a sponsor, there is no board approval. You should know that for test purposes. When a purchaser buys from a sponsor, there is no board approval. By law, the sponsor of a co-op generally holds the unsold shares allotted for the units in the co-op that are not purchased. In the middle of page 79, we talk about co-op or condo conversions. So in New York, when a developer files an offering plan with the Attorney General, sometimes they say AG, to convert an existing building to a condo or co-op, the tenants have a 90-day exclusive right to buy their apartment. That you have to know for test purposes. And that's if you happen to get a state exam that has a lot of downstate New York questions. You might get lucky and not have one like that, and that's good for you, you know. So during this time frame, the sponsor cannot negotiate separate prices. One tenant cannot be offered 15% off while another is given 10% off. Every tenant must get the same discount, and this has to be reflected in the offering plan as an amendment. In new buildings or new developments, the sponsor can separately negotiate the price of a particular apartment regardless of what's being charged for any other apartment without an amendment needed to the State Attorney General. The State Attorney General only regulates the proper disclosure of prices, but not the actual price. So Attorney General wants to make sure disclosure is taking place, which should not be shocking to you. They don't regulate price. New condos, in the next paragraph, are priced based on a price per square foot of the unit. The typical developer offers a few apartments at a time so that if the units sell quickly, he or she can release more units at a higher price. That's standard protocol. Sometimes the developer underestimates the building costs or the price for raw materials. They may change quickly, thereby resulting in the need to raise prices on subsequent units. Monthly common charges may also increase for a variety of reasons. So in the beginning phases, things could be quite fluid. Second last paragraph. As you know from the main text, a condo purchaser receives a deed to his or her unit plus an undivided, indistinguishable interest in the common areas. As with any other fee simple purchase, a title insurance policy might be needed, especially when there's a bank involved. And you want to make sure that they get clear marketable title, and that's what the title insurance will warrant. Generally, special endorsements are required to attach to the title insurance policy because of the potential for liens that might have been filed against a condo association for common area charges. Last paragraph. You can expect with a condo sale that the Board of Managers of the association will have a first right of refusal clause included as part of the sales contract. That's important because it comes up more frequently than you might think, especially if there's a lot of condos in your area. That first right of refusal clause will be in the sales contract so that Board of Managers of the association has the right in order to purchase that property. They don't want it to sell at a fire sale and bring down the value of all the other units that are in that complex. This essentially allows them the first opportunity to purchase a condo when it goes up for sale before someone outside can become eligible to buy it. At closing, the seller may have to present a waiver of this right issued by the Board of Managers of the Condo Association. As you might remember from references I made before, the real estate agent is the master of ceremonies. You're responsible to make sure that everything gets done properly. And sometimes you've got to make sure that the attorney's doing their job proper, the other real estate agent's doing their job proper, that the broker did what they're supposed to do, that the buyer and seller both did what they're supposed to do. Remember, if everything doesn't happen perfectly, you might not get paid a commission. So it behooves you to do this. And what we're talking about here is if you know that there's a board involved and that now that you know the law is that you have to get a waiver from the board that they've that they've said, okay, fine, we're not going to be, with our right of refusal is satisfied. You want to ask the attorney involved, did you obtain the right of refusal? Is it necessary from the board? Make sure you get things like this in writing. It's so easy to use email to verify things like this. And then there's a paper trail. So if something goes wrong, believe me, when something goes wrong in a real estate transaction, everyone wants to blame you. It's always the real estate agent's fault. So you always have to treat every part of the transaction like CYA, cover my you-know-what. You always want to cover your butt, okay? The final part of Session K, we look at property taxes and assessments. Open your books to page 136 in the front portion of your book, page 136. We're going to look in the middle of the page where it says property taxes and assessments. So in the italicized section, property taxes constitute a first priority lien against all real property. Make sure you know that for test purposes. Property taxes constitute a first priority lien against all real property. So even above a first mortgage, property taxes are first. As we continue, if an owner fails to pay his or her property taxes, an in rem foreclosure may take place. In rem is against the property as compared to the owner of the property. So if you're working on your flashcards, make sure that you put it one side of the flashcard should be in rem and the other side should be against the property as compared to the owner of the property. Okay, so in rem is against the property as compared with the owner of the property. Tax rates are set yearly by individual municipalities to raise whatever sum of money is needed for the public budget. The rate might be quoted in dollars per thousand of assessed value or in mills. That should be or in mills. For example, $30 per $1,000 of assessed valuation would equate to a $3,000 yearly tax bill for a $100,000 house. If the rate is expressed in mills, it might be expressed as $3 per 100 or 30 mills. A mill is 1/10 of a cent. You got to memorize that. A mill is 1/10 of 1 cent. So you need 10 mills to get a penny. If you get your calculator out and you take 1, then press the divided button, and then 10, you'll get 0.10. So a mill is equal to 1/10 of 1 cent. And if you get a math problem that happens to have this, just use the test of reasonableness. A lot of times if it's a tax question about property taxes, all you're going to do is say, well, taxes on a $300,000 house, they're not going to be $1,000 and they're not going to be $30,000. So that narrows you down generally to 2 options. And in the video clip that follows, we'll make sure that there's some examples of how to calculate tax rates based on mills and things like that. So you'll see a visual of this as well. In the box that follows under real estate units of measurement, I want to point out some of the most important ones to memorize. Please know that 1 link equals 7.92 inches. 1 chain is equal to 66 feet. 1 mile is equal to 5,280 feet. Again, 1 mile is 5,280 feet. A township is 36 sections, or 36 square miles. Of course, an acre is 43,560 square feet. 711. 4 plus 3 is 7, 5 plus 6 is 11. 43,560. 1 rod is equal to 16.5 feet. Okay? And then the last item I would want you to know for sure is 1 square mile. A square mile is equal to 1 section. 1 section is equal to 640 acres. That tends to show up more frequently on other state exams, but what happens with New York is it's a multiple choice throwaway option. Let's continue on page 136. In general, a property's tax assessment should reflect near its true market value, or about 90% of it. So if a property is located in a town that does regular assessments, that means their assessments are current. You're going to be about 90% of the true market value if you're at full value assessment. In many areas of the state, however, it's well below this number. So municipalities are under a lot more scrutiny by state officials for failing to do revaluations. They actually lose money when they don't do a revaluation, but sometimes they say they don't have the money in the budget. So that's the approach they take. They say, well, we'd rather take the loss than the benefit of having properties up to full value. The downside of not having properties at full value is it causes more confusion in the marketplace. It actually turns out too that people, if there's been studies about this, people tend to pay more in property tax when a revaluation hasn't been done in a long time versus when they're done on a regular basis. So I'm no fan of assessors, but long story short, full valuation tends to be better for everyone involved. When we go to the next page, I'll share with you the website to get all kinds of information about assessments and how assessors do what they do and how to challenge assessments. That'll be on the next page. Now, for the most part, the two closest municipalities to us that pretty much always are at full valuation is the town of Amherst and the town of Clarence. They're almost, I can't even think of a time in recent history that they haven't been at full value. Let's go to page 137. We talk about special assessments. Special assessments are additional taxes that run for a certain number of years to enable neighborhoods to pay for particular improvements that are made, such as sidewalks, water lines, etc., curbs, things like that. So when you look at a property tax bill, it's not going to say special assessment. That would be too easy. It'll have some crazy code that means nothing to you. Therefore, when you list a property, the only way to know if there's a special assessment is to come right out and ask the person at the tax office, can you please check the property record card and let me know if there's any special assessments on this property that I'm listing? Please put that in your parking lot section of your notes. It's something you always need to ask. The profile sheet for the Association of Realtors requires that you answer that question, and most people, they leave it blank. They don't even ask. So, and you can't go by asking the owner. The owners, let's put it this way. There's so many people that are paying special assessments for things that are already wearing out again because they've already been paying on it over 20 years. And these are usually smaller dollar amounts, but it adds up after a while. Every year I ask our classes, whenever I teach a class, I say, how many people own a home? They raise their hands. How many people specifically asked if they have a special assessment on their home? No one raises their hand. And then we've been watching this for a number of years, and it's always like 3 to 5 people will tell us, as a result of us mentioning in this class, call the assessor's office and ask if you have any special assessments on your property. And it's shocking how many people every year, year after year, 3 to 5 people will say, yes, actually I had one on my property and they took it off as a result of me calling, because it's such a negligible amount that they don't even make a big deal out of it. But frankly, it adds up. I'd rather get my free Tim Hortons out of what I pay than give that money to the assessor's office for no good reason. So I challenge you to check for your own property and see if there's any special assessments in place. And do that anytime you move to a new property, because once you're there, you'll know if there was one added. Because if you bought that property and you never specifically asked that question, and you can't rely on the fact that the realtor remembered to do that, because they make, like, it's not even a big deal to most people, you need to ask yourself. So page 137. Special assessments in the second sentence. Special assessments should be disclosed to any prospective purchasers of real property. If a special assessment is imposed on a parcel, the tax bill will generally note it separately. But again, it's a code that doesn't mean anything. They don't say the word special assessment. When listing a property, agents should take great care to investigate whether a special assessment is imposed or not. If you're not sure, just contact the municipality and ask them and get it in writing. At least confirm that you asked the question. Second paragraph. Taxpayers who feel their assessment is unfair can contact their assessor's office to obtain information on protesting their assessment. This next part here has shown up on multiple choice questions before. There is a presumption that the assessment made by the assessor is correct. So the onus is on the property owner to prove the assessor wrong. And don't think you're just going to take pictures of the ugliest rooms that haven't been updated in your house. Because if the assessor's office knows that you updated the kitchen and there's a new roof and you don't mention any of that when you protest an assessment, they're going to just throw your whole thing out. You'll get nothing. You won't even get the negligible $8,000 to $12,000 that they give you just so they can throw you a bone and hope that you'll go away. So when you challenge an assessment, make sure it's fair and balanced. Make sure you show the good and the bad. So the next sentence, the burden of proof is on the property owner. We've already mentioned that. Real Property Tax Law Section 510 requires that the assessor notify the taxpayer by mail of any increase in assessment at least 10 days before the date for hearing assessment reviews. I'm happy to tell you you don't need to know Real Property Tax Law Section 510, but you do need to know about the 10-day rule. It's 10 days before the dates for any hearing of assessment reviews. So, it is a property owner's responsibility to check their assessment on the tentative roll after it's been filed. Failure to receive a notice of increased assessment will not invalidate the assessment change. And it's usually pretty well publicized, especially if you're in a municipality like Amherst. You know, if you watch the news. Now, if you're one of those people that don't like the news and you think it's always bad news, this is the stuff that can sneak through, and then you might not be aware of it, especially if you're a busy kind of person. Because when it comes to challenging your assessment, there's real specific deadlines, and you're not tested on these deadlines. But, you know, as a real estate agent, you're a source of, you know, you're a main source of real estate information. So people will ask you these questions, and it's much better for you to be familiar with the dates for your municipality than to just say, oh, you know, I don't know. Every time you say I don't know, people, you know, they start wondering, well, are you really a source of information? Okay? I mean, there's a lot of mediocrity out there. Don't add to it. You know, if you're gonna get into this business, take it seriously. Just don't do it half-heartedly. Most towns and villages establish the valuation date, or the date the real property price level for the assessment cycle is frozen, as of May of each year in Erie County and July for Chautauqua and Niagara counties. Incorporated cities in the state are typically on a different schedule. So if you're a city of Buffalo, for example, they do have a different schedule. And the website to go to is ORPS. That stands for the Office of Real Property Services. So ORPS in the final sentence of paragraph 2, that stands for the New York State Office of Real Property Services. And that's the website to get to it. If you ever forget, just go to Google and type in Office of Real Property Services, New York State. In the next paragraph, many individuals hire a private state-certified appraiser to assist in the assessment process. It's important that the property owners understand that an individual cannot act as an appraiser and as an advocate in the same assignment. The appraiser may provide litigation services by either acting as an appraiser or acting as an advocate for the client's cause. So as a result of this, it's pretty hard to find an appraiser who will appraise your property in order to help you get a lower price. So if you got a loan on and this is what's kind of tricky too. If you recently refinanced your property, the assessors pull that information. They've been doing it for years now. At one time they didn't do that, and now they've really smartened up because, you know, they act like it's their money coming out of their pocket, their individual pocket. That's how they act. So what they'll do is they'll see, oh, you got a mortgage 2 years ago. So they extrapolate and they say, well, if you got a $180,000 mortgage, then it had to have at least appraised for 185 to 195. At least, probably more. So if you're saying that the house isn't worth even 170,000, all day long they're not going to buy it. So you can't fool the assessor anymore. You used to be able to get away with showing really dilapidated properties, and they just don't go for it. You really have to have a good quality market analysis, or you can use the appraisal for your refinance if it supports your case. In my theory, when it comes to challenging your assessment, is this: you want to make sure that whenever you can prove a lower value, you do it. You absolutely do it. Don't just let it go if it's, if you can only prove a value of $3,000 to $5,000 less, just let it go. Who cares? Because what happens if you do that, then you have a higher base that you're working with. And then a couple years later, it could go up a few thousand again, 5,000 again, 10,000 again. And before you know it, you're way over on what your property is assessed at. And it's going to hurt the sale of the property. It's going to require that you pay more in property taxes on that home. And that actually brings your value down. So it becomes a hindrance if your property assessment is so much higher than what you actually can sell the property for. And we go in cycles. There's cycles that this occurs in. Like right now, with property values going up so much because of a shortage of properties, it's not going to be as much of a problem. But don't worry, real estate is very cyclical. As soon as things turn around and things calm down a bit, you're going to start seeing an imbalance when it comes to assessments from people that just write the check, they don't even care, and next thing you know, the properties are assessed for too much. Fourth paragraph down has some really important information you need to know for test purposes. If no agreement results with the tax assessor at the first level, we call that the informal review. So please know that. The informal review is your first initial contact with the assessor's office. That's where if you purchase a property and you're within the time guidelines and you purchased it for $150,000 and it's assessed at $180,000, and there were no extenuating circumstances. In other words, it was offered on the open competitive market for a reasonable period of time with no unusual circumstances. You go in, you show your contract of sale, you show your financing paperwork, and at the informal review, the assessor can say, you know what, we got that one wrong. And they can just adjust your assessment and you're good to go. No problem, no big fight. That's the perfect scenario when that happens. But that doesn't always happen too often. So the next formal step in that same sentence, the next formal step is to present a grievance at the local Board of Assessment Review. So they call that the LBAR, Local Board of Assessment Review. The taxpayer who wants to take matters beyond this point has to go to court. And the court for residential property is called a SCAR hearing, SCAR. That stands for Small Claims Assessment Review. Now, if you have a commercial property, you can't go through SCAR. If it's a corporation that owns a property, you can't go through SCAR. You've got to go through the other court system, and which goes beyond what you need to know for here. Okay? So first you've got the informal review, which isn't even considered a formal step. That's why we call it the informal review. Then you've got the local Board of Assessment Review, the LBAR. Then you've got the SCAR, Small Claims Assessment Review. So know the process and know the steps. And there's very specific deadlines for local Board of Assessment Review and the SCAR hearings. You miss those deadlines, you're done for the next year. You can't do anything until the next year. There's no excuses. There's no flexibility whatsoever. For most residential properties, a taxpayer cannot bring suit in court unless he or she started the process by filing a grievance at the local Board of Assessment Review. So you can't skip steps. That's what we're saying here. You cannot skip a step. You can't file a SCAR if you didn't file the LBAR, the local Board of Assessment Review. So please know that for test purposes, and it's just something you should know anyways as a real estate professional. In the next paragraph, we talk about qualified veterans and senior exemptions. So qualified veterans and seniors can take advantage of property tax reductions available in most areas of New York State. Now, they have to be participating communities. So, if you're going to an assessor's office and one of the things we talked about in an earlier segment is to go around to the local towns. And when you're going around to the local towns, you want to ask questions like, is there anything that I need to be aware of as far as inspections that can affect the transfer of property? And that's where in Tonawanda, for example, you have to have the sump pumps tested prior to closing. So that's a certificate that you want to get done. Well, when you're there asking about things like that can affect the transfer of property, you also want to ask, what are the rules and regulations in place for senior citizen exemptions and veteran exemptions? And find out what you need to know about that. So this way, you put it in the file and here's the rules for Amherst, here's the rules for Clarence, here's the rules for Lancaster. And there's been a lot of updated information as far as the STAR exemptions are concerned. That's a school tax relief program that's in place. That used to be all left on the assessor's office. Now the state's kind of grab the bull by the horns, and the state now deals with the verification because people were trying to scam the system. And it kind of blows my mind how people think they're going to get away. How they're going to get away with things, like literally if they own 3 or 4 properties, they're taking the STAR exemption on multiple properties. And you only get 1 STAR exemption for your own primary residence. You don't get to take it on rental properties that you don't live in. You get 1 per person. So if it's your primary residence, the property's in your name, then the potential is there. And then you've got to meet any other requirements, and they do change periodically. So you want to be up to speed on that as well. People will ask you at that time of the year when a STAR exemption comes out, they're going to ask you questions. So you got to know what's current. I'm happy to tell you this, you're not tested on this, but know that that's something that in the field you may be tested. So next sentence in that paragraph. The exemption is typically made based on a reduction of the property's tax assessment. For example, a $90,000 true tax assessment may be reduced $20,000 for a qualified veteran. So the resulting $70,000 assessment would then be applied by the tax rate per thousand to arrive at the adjusted annual tax. Now the deadline, historically, for most exemptions is March 1st of each year. While we're talking about exemptions, just be sure that whenever you list a property, you never quote the taxes on the house based on receiving an exemption. So if you're there and the people, you have to ask the question. You can't look at them and say, oh, well, you look young, you probably don't have a senior citizen exemption. People look really good these days. Some people look really good. So you have to say to them, are there any exemptions that you're getting on your property taxes from anything at all? And then you got to throw things out like the STAR exemption, any kind of senior or veteran exemptions. And then if they say yes, then you've got to calculate the taxes and quote the taxes based on what somebody in the open marketplace who's not receiving any exemptions, what they would pay. Because believe me, any buyer that's looking at a home, they will know if they qualify for a senior exemption or a veteran's exemption, and they'll make sure that they get it. Hopefully they get it on time, but Murphy's Law is the property will close and it'll be too late to apply it for that year. And that's just the way it goes. And that's where we end Session K, except for the video clips that will follow to reinforce what we've covered so far.
If you pay property taxes in New York State, you may be entitled to certain exemptions that can lower your tax bills. As you can see, there are many different property tax exemptions, almost all of which are offered by local municipalities and school districts. So you should check with your local assessor to see which exemptions may be available in your community. For today, let's touch on some of the most common exemptions that can save homeowners the most on their property tax bills. If you own your home, you're most likely eligible for a school tax relief or STAR exemption. STAR is offered statewide and can save you hundreds of dollars on your school property tax bill if your home is your primary residence. There are 2 types of STAR exemptions, basic and enhanced. The basic STAR exemption is available to all homeowners whose income is less than $500,000. Enhanced STAR is available to income-qualified senior citizen homeowners. The income limit changes annually, so you should check with your assessor or visit our website for the current income limit. Most local governments and school districts also offer an exemption for senior citizens with limited incomes. Seniors who qualify may be able to exempt up to 50% of their property's assessed value. The income limits are set by municipalities and school districts, but are somewhat lower than the income limit for Enhanced Star. Check with your local assessor to find out more about the senior citizens exemption offered in your community. There are also some special exemptions offered to veterans. These exemptions are available for county and municipal taxes, but not for school property taxes. The alternative veterans exemption is offered by municipalities and provides a property tax exemption of 15% of assessed value to veterans who served during wartime. This exemption is increased to 25% for those who served in a combat zone. Additional benefits are available to those who suffered a service-connected disability. New York State also offers an exemption of 10 to 15% of assessed value to veterans who served during the Cold War period from 1945 to 1991. This exemption can only be claimed by veterans who are not claiming either the alternative veterans exemption or the eligible funds exemption, which can provide a partial exemption from real property taxes on property paid for with money from veterans benefits or insurance payouts. Call your local assessor or the New York State Division of Veterans Affairs to learn what exemptions are offered to veterans in your community. Another common exemption is the exemption for persons with disabilities or limited incomes. Applicants must provide documented evidence of their disability and meet income limitations set by the municipality. For those who qualify, this exemption can reduce the assessed value of your home by up to 50%. Again, check with your assessor as to whether this exemption is offered in your community. For more information on these or other property tax exemptions, visit us at our website at www.tax.ny.gov.
Hi, I'm Patrick from the New York State Tax Department, and in this video, I'm going to give you an overview of property taxes, what they're for, how they're collected, and how to make sure your assessment is fair and accurate. In New York, school districts and local governments use property taxes to fund public education and to pay for services like police and fire departments. The amount of your property tax bill is based on the total value of real property you own. Real property, or real estate, is generally defined as land and any permanent structures attached to it. This can include houses, gas stations, office buildings, and vacant land, as well as farms, apartments, and in most cases, mobile homes. The total value of your real property is determined by a local official called an assessor, and the determination he or she makes is called an assessment. Assessors are typically employed by towns, cities, villages, or counties. To ensure that all properties are assessed fairly, your assessor should conduct reassessments on a cyclical basis. Reassessments are the best way to ensure that all property owners pay only their fair share of property taxes. For homeowners, your assessor should base your assessment on the current market value of your property. He or she can determine the market value by looking at recent sale prices for similar properties in your community. Once your assessor determines your property's market value, he or she will calculate your total assessment by multiplying the market value of your property by the local level of assessment. If your city or town was recently reassessed, the level of assessment will still be close to 100% of market value. However, if it's been some time since the last reassessment, it's likely that the level of assessment will be less than 100%. The longer it has been, the lower the level of assessment will be, and the more likely that your assessment is no longer accurate. If your community assesses at 100% of market value, the total assessed value of your property should be roughly equal to its market value. If assessments are not at a market value, you can use the market value listed on the assessment roll as a starting point to determine if you've been assessed fairly. The assessment roll is a listing of all assessments in your community. And in most communities, this listing is first made public in the beginning of May. We encourage you to check the assessment roll each year to ensure that you're assessed fairly and are receiving any exemptions for which you're eligible. If you feel your assessment is inaccurate, you have the right to contest it. Our website provides more information on this process, including an informational video called "Is My Assessment Fair?" Keep in mind that a change in your property assessment doesn't mean you'll see a change in your tax bill. Your actual tax bill only changes when bigger local budgets are adopted, other revenue sources shrink, the total of your assessed property in a municipality changes, or the tax levy apportioned to the different municipalities changes. So, how does your assessment translate to the amount of taxes you pay? First, taxing jurisdictions, school districts, municipalities, counties, and others have to determine the amount of revenue that needs to be raised to fund public services. They determine their budgets, the total projected expenses for the year, and then subtract all revenues from sources other than the property tax. The result is the levy, the total amount of property taxes to be collected. The tax levy is then divided by the total assessed value of the jurisdiction to arrive at the tax rate. Ultimately, your assessment will be multiplied by the tax rate to arrive at the property taxes you owe. For more information on property taxes, watch our other informational videos or visit our website at www.tax.ny.gov.
Before we can wrap up Session K, we have to cover taxes and assessments in the GAP part of the program. So please open up your textbooks to page 72 in the GAP part of the program. That's a section that follows the green tab. And just a little bit to cover here, and then Session K will be complete. So the bottom half of page 72, where you see the word taxes. We have to look at some terms that show up on the state exam. Appropriation. Appropriation is an amount of money made available by a governing body for expenditure according to an established budgetary and accounting practice. Before a tax levy can be introduced to the municipality at large, appropriation occurs. Okay? Next, we look at homestead. Dwellings having 4 units or less. You can also have farms, residential condos, owner-occupied mobile homes, basically anything that would constitute as a home for a person. It does not include commercial properties or industrial zone properties as you read through that paragraph. They have to be non-commercial properties in nature. So homestead is non-commercial in nature, where people could live. Third term we look at is approved assessing unit. So approved assessing unit is certified as having completed a revaluation program that implements a system of real property tax administration which would be considered eligible based on the latest completed assessment roll for state assistance. Then we see equalization. The attempt by raising or lowering of assessed values to make for tax purposes assessments more equal. Typically, this is done when a municipality fails to perform revaluations on a regular basis. So what we're trying to say here with equalization is you don't need equalization if the municipality keeps assessments at full market value or nearly 100% of value. Equalization occurs whenever the municipality falls years and years behind or hasn't had a reassessment in decades. That's when you're going to run into equalization. And it doesn't even have to be decades. It can be a much shorter period of time. Just a few years could be enough that you would need to have an equalization rate, so you could multiply it against the value of the property to come up with what the true value or close to what the true value of that property would be. Then we see the term special assessment district. These are geographic areas designated to pay for infrastructure costs for a specific project that benefits a specific area. Then we see a term you should be familiar with, the SCAR, or the Small Claims Assessment Review. So automatically you should know from what we covered that that's the second formal phase in the assessment challenge process. So real quick, I would say to you, what's the name of the first official step or the first formal step? And you should know that that's an LBAR, Local Board of Assessment Review. So the SCAR hearing is the second formal hearing that we have that follows a local Board of Assessment review. So let's look at the official definition at the bottom of 72. If a homeowner is dissatisfied with the decision of the local Board of Assessment review, this is one of the two final options, the other being what we call a tax certiorari proceeding in state Supreme Court. So when you heard me say earlier in the program that if a person has a non-residential property or a property that they don't live in and they can't go through the normal procedures of a local Board of Assessment review or a SCAR hearing, then they essentially have to do what we call a tax certiorari proceeding at state Supreme Court. In the final couple sentences, page 72, SCAR hearings, you should know this, SCAR hearings are only allowed for owner-occupied 1 to 3 family residences, as well as owners of vacant land that's not large enough to accommodate a residential dwelling and must be initiated within 30 days of the filing of the final assessment roll, or notice of such filing, whichever is later. So the SCAR hearing is a type of review that's not available to commercial or non-residential properties, as we just noted. Page 73. Again, we're still in the gap portion of the book. Top of the page. The purpose of taxation is to pay for municipal services. Real property taxes are the most important revenue source for local schools and governments. School taxes are often the largest part of the New York property owner's annual tax bill. And believe me, anyone that owns a home, they're very familiar with that. As a matter of fact, the time frame passed not too long ago. It's always around October 15th. A homeowner's property is taxed based on the concept of ad valorem. Ad valorem, you should know for its basic real estate 101, according to valuation. Properties are valued based on the concept of ad valorem, according to valuation. Second paragraph, page 73. All real property is subject to assessment unless they're specifically exempt. Property owned by religious organizations, government entities, etc. are exempt, while partial exemptions are available to other property owners. And you should think to yourself, veterans, senior citizens, handicapped owners are eligible for partial exemptions. In the third paragraph, we talk about tax rates. Tax rates are a direct result of the tax levy. So first, a municipality has to develop a budget. They consider all revenue sources, including those from state and federal governments, including sales tax, user fees, etc. Then, they have to subtract the revenues from the original budget. The number that remains after this is the tax levy. So, before a tax levy can be introduced to the property owners, an appropriation occurs. If the total taxable value of all real property subject to tax is, let's say, $49 million, you would divide the total tax levy, and that's what the town has to spend in order to function and pay for services, pay for firefighters, pay for employees, everything, police. So if that number is $1.8 million, then the tax rate would be as follows. 1.8 million divided by the total value of all property in that municipality. So we said $49 million, just for our example. So when you divide that small number of the total tax levy into the bigger number, the total taxable value of all property, you come up with a tax rate of 0.037. So we break this down because if you get a question on the state exam, you want to use the test of reasonableness when you're trying to figure things out. So 0.037, you can now multiply that against the property value of an individual property to come up with what the approximate taxes are for that property. In the middle of page 73, this may be expressed different ways. The tax rate above may be stated $37 for each thousand of taxable assessed value. So if the tax rate is expressed as mills, so a mill is 1/10 of 1 cent. It's also expressed as 1 over 1,000. So a property assessed for 120,000 would have an annual tax bill of, and then we show you the math. The assessed value of the property is 120,000. We multiply that by 37, which is the tax rate. Then we divide that by the mills. So The $4,440,000 divided by 1,000 gives you the tax owed of $4,440. And you might say to yourself, why is that such a big number, $4,440,000? The reason why is because a 1 mil is equal to 1/10 of 1 cent. So there's a lot of 1/10 of 1 cents in every single dollar if you're using assessed value of a $120,000 house. I wouldn't overanalyze it. We'll make sure that at the end of this section we include a video clip that goes through step by step some more examples of how to calculate the value of a property using tax rates and mills, okay? Just so you don't go crazy over it, because it's real easy for your brain to start shutting down, especially if you're not a math person, okay? Bottom of 73. The tax assessor is the local government official who estimates the value of the real property within the municipality. The value is converted into an assessment, which becomes a component in the calculation of real property taxes for the home. That paragraph concludes with other functions of the assessor, such as approving property tax exemptions, filing various reports, communicating with the public, inspecting properties, etc., etc. Second last paragraph. In New York State, improvements that increase livable and usable space, as well as improvements that become part of the realty, should be part of the assessed value of the property. Typical examples of items that add value include decks, sheds, central air, patio, room additions, space conversions, etc. Last paragraph, page 73. In New York State, the assessor is presumed to be correct with regard to the property assessment. We mentioned this earlier in the program. The property owner has the burden of proof to overcome. An informal review with the municipal assessor is generally the first step that you would want to pursue, and we already went through all of that. And then we tell you again, step 2 is filing a complaint with the local Board of Assessment Review, and that's filing a timely complaint. Then homeowners or their authorized representatives can then move forward and pursue a SCAR hearing as long as they didn't skip any steps and they did everything timely. If they did not do things timely, they cannot go to the next step. They have to wait until the following year. We wrap up on page 74 in the gap section. You should know for test purposes the first paragraph. There are 4 grounds in New York State on which we can challenge a tax assessment. Number 1, excessive assessment. Number 2, unequal assessment. Number 3, unlawful assessment. And number 4, misclassified assessment. With an excessive assessment, the property owner believes the property is assessed for more than its full market value, or is excessive because of the denial of all or a portion of a partial exemption. Unequal assessment refers to the property being assessed at a higher percentage of its full market value relative to all the other properties of the same class that's on the assessment roll. And from my experience, proving an unequal assessment is pretty difficult to do. It's usually the only thing you usually can prove is an excessive, number 1, an excessive assessment. Also, there's unlawful assessment, and that can include a number of technical items, such as the property is maybe wholly exempt, or that a person without authority made entry into the record. In other words, it was like a clerical error was made. In the third paragraph, please note, the amount of property tax in itself is not grounds for filing a grievance, as assessors will tell you themselves. They'll tell you that they don't raise or lower your tax bill. Assessors only want to provide a fair evaluation of what your property is worth in today's market, or very reasonably close to it. And I'll tell you, if you ever pay attention to a local Board of Assessment review, it's really funny to watch homeowners get all aggravated and say, my taxes are too high, and that's why I'm here. Like, that is a guaranteed, surefire way to not get anywhere with that board. Final paragraph to look at on page 74, and then we're completely done with Session K. Commercial property owners may also file assessment complaints with the Board of Assessment Review. The only exception to the overall process is that the SCAR hearing is not allowed. A formal review request in the New York State Supreme Court must be initiated. And again, we call that a tax certiorari proceeding. So they can do the local Board of Assessment review, but if they're not happy with the results of that, and just to be clear, a lot of people get very minimal adjustments at that local Board of Assessment review. And another thing very few people know, and you're not tested on this, I'm just telling you from my experience, they can turn around and raise your property assessment the following year if you only go to local Board of Assessment reviews. In other words, if you only challenge it at that first formal level. But if you go to a SCAR hearing and you take it all the way that you can, even if they reiterate what happened at the lower review, at the local Board of Assessment review, then they can't touch you for a minimum of 2 years. And usually it's more than that, but it's a minimum of 2 years. And that's what I really like about the SCAR hearings. And hardly anyone ever talks about that. You've got to read the fine print in the challenge, in the assessment challenge paperwork, in order to find out about that. Okay, so now we're going to look at some math examples using mills and tax rates.
So a town needs an $850,000 to meet its budget. Its total assessed value of all its properties is $33,650,000. Let's determine this municipality's mill rate in mills. So I take my required revenue. So my revenue divided by my total assessed value. The revenue was $850,000. I'm going to divide that by the value of $33,650,000. Now to make this into a mill rate in mills, I'm going to multiply by $1,000, or 1,000. This multiplying by 1,000 is going to be a key point when we actually look at how to do our property taxes. So I'm just going to take these two numbers and divide them. 850,000 divided by 33,650,000, and I get 0.0252. I'm going to times by 1,000 to get a mill rate of 25.2 mils.
In short, our city's budget requirements value. This looks simple, but what happens if the assessment values change? Okay, let's assume the following year calculated each year, but all in all,